What's going on, everybody? My name is Tyler, and I just finished reading The Little Book of Common Sense Investing. And if I had to summarize the whole book up into one sentence, it would be buy index funds, keep buying index funds, and never let go of your index funds. But I want you guys to have a full understanding of the arguments behind the index fund approach. So I'm going to break down the main points of this book one by one. Then we'll take a look at how average investors like you or I can use the points in this book to become better investors ourselves. Personally, this book completely changed my perspective on investing, and I'm sure you guys are going to feel the same way. So don't go anywhere. The stuff I'm going to talk about in this video could make you tens of thousands of dollars richer in the future. I want to jump right into this, but first we have to talk about the author of this book, John Bogle. Bogle spent his entire career in finance, including over 20 years at the Wellington Fund, which is one of the oldest mutual funds in existence. After years of managing, investing, and analyzing finances, Bogle had the idea for the very first index fund. In 1974, he started the Vanguard Group, where he would offer the first index fund to investors. Today, the Vanguard Group is one of the biggest names in investing, and Bogle single-handedly changed the entire investment landscape before he passed away in 2019. Fortunately, he wrote this incredible book before he did, which we will all be forever grateful for. I just want you guys to understand that John Bogle knows his when it comes to investing. In the Little Book of Common Sense Investing, Bogle explains the power of the index fund and why it's a superior investment strategy. Or in his words, while it may not be the best investment strategy, the number of investment strategies that are worse is infinite. So I'm going to quickly explain what an index fund is, and then we can get into the main points of the book. An index fund is a collection of multiple stocks or bonds represented in a single security. Think of it like a basket filled with a diverse group of stocks. By investing into the index fund, you get to invest in all of the stocks inside of it. The key here is we're talking about the traditional index fund as it was created by Bogle. The traditional index fund represents the entire stock market, so it can be made up of over 3,000 different publicly traded companies. The weight of a given stock inside the index fund is determined by its market capitalization, or market cap, which is a way of measuring the value of a company. So, a company like Apple, which is valued in the trillions, is going to take up more space in the index fund than a company, say, like CarMax, which is only worth a few billion. I also want to quickly differentiate this total market index fund to other index funds, because there are some index funds that focus on only specific sectors of the market, like technology or healthcare. And these types of index funds will be inherently more risky than a total market index fund. So just keep in mind for this video, we're talking about the total market index fund when it comes to Bogle and the Little Book of Common Sense Investing. So hopefully you can already see how the index fund offers diversification and less risk than many other investment approaches. When you consider the tax advantages, cost advantages, and the ability to generate compound interest, it's no wonder why the index fund has historically been an incredible investment for long-term investors. And you'll see why these qualities are so important as we start comparing the index fund to other investment options. And the first comparison we're going to make is to the mutual fund. Now, the mutual fund was one of the leading options for investors before index funds were created. And it may sound like a good idea at first. With a mutual fund, you're trusting a financial professional to allocate your investments across the stocks and bonds that they have handpicked. Mutual funds draw in a lot of investors because fund managers claim that they can beat the returns of the market. But historically, when you compare them to the returns of index funds, it isn't actually true. The problem with actively managed mutual funds is in the name. They're active. For one, you're always going to be paying fees to have somebody else manage your portfolio. No matter how small your fee is, you can expect it to affect your returns every single year. And as Bogle explains, costs can begin to compound just as easily as your interest. If your mutual fund is charging just 1 or 2% for annual fees, that can still cost you hundreds of thousands of dollars in the long run. These costs will eat away at the returns you've been generating, as well as any dividends that you've earned in the process. Index funds, on the other hand, have an annual fee that is usually less than 0.1%. So that's already a huge difference in the fees you're going to be paying year over year. Actively managed mutual funds also have a lot of portfolio turnover. And this is because fund managers are frequently buying and selling stocks to rebalance the fund to their liking. Every single trade that your fund manager executes is going to make you incur a capital gains tax. And that's another cost that's going to be coming out of your returns year after year. Index funds, on the other hand, hold all stocks at all times. So there's no trading going on and no hidden taxes coming from your investment. Taxes, just like the costs and fees of management, can compound and restrict your growth. And finally, you have to consider what Bogle calls reversion to the mean. And this is going to refer to the high rate of returns that mutual fund managers often advertise. The main draw of a mutual fund is that they advertise that they can beat the market. In truth, it's nearly impossible for mutual funds to do this year after year. While mutual funds may perform well for a few years in a row, eventually they're going to return to average. And in this case, average just means the total market performance. And keep in mind, you're also going to owe taxes and fees on that average performance, which means your returns are actually going to be less than average. On the other hand, a total market index fund is the average performance. It reflects the entire market. And there's less risks and costs involved. And these reasons are why for the last 25 years, mutual fund investors have earned far lower returns than index fund investors. Over this time period, mutual fund investors earned an average annual return of 6.3%. But index fund investors earned an average annual return of 9.1%. A $10,000 investment into each 25 years ago would have today earned a mutual fund investor $46,000, or an index fund investor a total of $88,000. If you're investing for the long term, as most young people are, index funds are the clear winner. Or maybe you're a little more confident and adventurous, and like me, you thought, sure, I could pick a good stock. The problem is this approach is inherently flawed and risky because of our greed, our emotions, and our short-sightedness. And this couldn't be any better illustrated than by comparing individual stock picking with index fund investing. When you pick individual stocks, there's excitement around trying to pick a stock that's going to be the next big winner and trying to get returns that are going to be better than your peers. This is going to make you trade more often and probably with a lot of emotion. As a result, you're going to incur all of the taxes and fees from trading, as well as the loss of any returns that you miss out on by either trading too early or buying in too late. Just like mutual fund investors, the chances of an individual investor choosing a portfolio that outpaces the market is incredibly low. You'd be lucky to do it 1 year, and the chances of you doing it repeatedly over the long term are near impossible. So instead of wasting time researching and trying to build the perfect portfolio, which can never really be perfect, it's better to just buy into an index fund and get instant diversification that can also secure you any returns that the market sees. As they say, time in the market beats timing the market. The costs and risks of actively trading stocks will make you a loser nearly every single time. Bogle compares the stock market to a casino, and that the house always wins. Brokerages profit off of your trading while you lose money trying to beat the market. Instead, you need to buy into an index fund, hold it forever, and get out of the casino that is the stock market. The third kind of investment we're going to compare to index funds are ETFs, or exchange-traded funds. And Bogle refers to these as wolves in sheep's clothing. On the outside, ETFs look a lot like index funds or mutual funds, in that they're made up of a group of different stocks or bonds. But they have two specific qualities that are problematic for investors. And the first one is that ETFs are designed to be traded. Like regular stocks, they fluctuate in price throughout the trading day based on market activity. ETFs almost encourage you to trade throughout the day because the price fluctuates, and this is what gets the attention of a lot of day traders. Index funds, and mutual funds for that matter, have their prices set once per day at the end of the trading day. This means you can't actively trade index funds and mutual funds because you can only buy them or sell them at the end of the day when everybody else is making the same transaction. Bogle says ETFs can still be a good long-term investment, but only if you don't trade them. And this is because, like we said earlier, trading will rack up taxes and fees that eat into your returns. And second, ETFs aren't necessarily representative of the whole market. There are some ETFs, like the Vanguard Total Market ETF or the Spider S&P 500 ETF, that track the full market. But a majority of ETFs actually specialize their holdings around a specific sector of the market, such as healthcare or technology. And this means that your investment is going to be less diversified, more risky, and more volatile. In summary, ETFs can still be a good long-term investment, but only if you make sure that they track the whole market, they have low costs, and you never trade them. And with most ETFs, the costs really aren't in your favor, so you're better off choosing an index fund in most cases. And the final type of investment that Bogle compares to index funds are bonds. Now, bonds are a different type of investment than investing in stocks, but a lot of the principles of index funds can still apply to bond funds. You can find a number of total bond market index funds, which offer stability and diversity in the bond market, similar to that you would get from a total market index fund in the stock market. Similarly, actively managed bond funds are going to be less efficient in the long run because of the costs of active management. It's definitely worth mentioning that even though bond index funds have a good track record, they've historically offered lower returns than stocks. But it's still an attractive option for many investors because it offers less risk and less volatility than investing in the stock market. So Bogle says the question isn't should I own bonds, but rather how much of my portfolio should be made up of bonds. Generally, younger investors are going to want to hold a smaller percentage of bonds, while older investors are going to want to hold a higher percentage of bonds because they'll have a more immediate need for their investment funds. But this is a topic I'll explore more in depth in a future video. Alright guys, I know we've come a long way, so I'm going to wrap it all up by summarizing the benefits of the index fund as argued by Bogle. First, index funds minimize risk by spreading your investment across the entire stock market. This protects you and I from making the mistake of selecting a single stock and possibly missing out on returns elsewhere in the market. This also protects you from selecting a mutual fund manager who might use your money to back the wrong portfolio. Second, index funds reduce the cost of investing by eliminating the management fees that you often find with mutual funds and ETFs. These costs can range from 1 to 3% or higher, and just like interest, they can compound over time, costing you hundreds of thousands of dollars in the long run. Vanguard is still one of the leaders in index funds today, and most of them have annual fees less than 0.1%. Plus, it's even cheaper to invest today because of apps like Robinhood, M1 Finance, and Webull that allow you to invest with zero commissions or fees. Third, index funds minimize your tax obligations because their portfolios have minimal turnover. This will save you from the tax costs of individual stock trading and investing in mutual funds, which makes index funds an even more affordable option. Finally, index funds are the only way to secure your fair share of market growth and profits. It's pretty much impossible to beat the market repeatedly, and comparing the returns of index fund investors to individual stock traders and mutual fund investors, it's pretty clear. Again, time in the market beats timing the market. So if you want a smart, simple, and effective investment strategy, you need to buy the index fund, keep buying the index fund, and hold on to the index fund for your lifetime. Overall, I think Bogle makes a pretty convincing case for the index fund. Throughout the book, he drives home his points with impressive data and quotes from some of the world's most respected financial gurus, including a specific endorsement from Warren Buffett. I cannot recommend this book enough as it totally changed my perspective on investing. And there's no jargon or complex language, so it's a really easy read for an investor of any experience level. And if you don't like reading, I got you. Click on the link in the description to sign up at Audible and get 2 audiobooks completely for free. You can download this and another book. You can even download this book twice. I'm sure you would not regret it. Personally, I'm focusing a large chunk of my investment portfolio on index funds moving forward, and reading this book made that decision so easy. But I'd love to hear your take on the index fund approach. Are you investing in index funds, or are you putting your money elsewhere instead? Leave me a comment below and share your thoughts. Well, that should do it for this video. If you're still watching, thanks for making it this far, and I'm sure your investment portfolio will also be thanking you in a few years. But before you go, make sure you subscribe to the channel so I can keep dropping some financial knowledge into your YouTube world. Other than that, take care, and I'll see you again soon.